Have you ever stopped to think about how your financial decisions reflect your life? Have you wondered how your psychology affects your relationship with money? Money is not only a medium of exchange but also a mirror that reveals our deepest values, beliefs, and experiences. On this journey through the financial world, we will explore how our monetary choices reveal our priorities and what we truly value in life. From the power of saving to the patience required for successful investment, we will discover how each financial decision shapes our path toward stability and growth. The Psychology of Money, written by Morgan Housel, is a book that explores the complex relationships between money and human behavior. Housel examines how our emotions, beliefs, and personal experiences influence our financial decisions and how these decisions can affect our long-term financial well-being. Before we dive into the 10 lessons from the book The Psychology of Money, let's take a look at who the author is and what his background is. Morgan Housel is a writer and financial analyst known for his expertise in the field of personal finance and investments. Housel has worked at several renowned financial firms and has contributed to major financial publications such as the Wall Street Journal, Bloomberg, and The Motley Fool, among others. He is recognized for his ability to communicate complex financial concepts in an accessible and understandable manner for the general public. His focus on the psychology of money and human behavior has made him an influential author in the field of financial education. In addition to his work as a writer and financial analyst, Housel is the author of books like The Psychology of Money, where he explores the intersections between psychology and personal finance. His work is widely respected and has gained followers for its insightful and practical approach to managing money and making smart financial decisions. Now, let's begin with the 10 lessons. Money is a mirror of life. Our financial decisions reflect our values, beliefs, and life experiences. For example, how we spend our money can reveal our priorities and what we value most in life. For instance, someone who prioritizes financial security might be more likely to save diligently, while someone who values experiences might be willing to spend more money on travel or recreational activities. Our relationship with money is influenced by our past experiences, including how money was handled in our childhood and the financial experiences we've had throughout our lives. These experiences shape our attitudes toward money and can influence our future financial decisions. Saving is more important than investment. Before venturing into the world of investment, it is crucial to have an adequate emergency fund and avoid excessive debt. Saving provides a financial safety net that can help cover unexpected expenses and avoid the need for costly loans in case of an emergency. The act of saving requires discipline and practicing healthy financial habits, such as living within your means and avoiding impulsive spending. These habits are fundamental to long-term financial success and can lay the groundwork for effective financial management in the future. Having savings means having options. It gives you the flexibility to pursue opportunities that may arise, such as changing careers, starting your own business, or making significant investments in your education or that of your loved ones. Having adequate savings can significantly reduce financial stress and provide peace of mind. Knowing that you have a financial cushion allows you to face adverse situations with greater confidence and stability. Once you have established an emergency fund and have your debts under control, you can start considering investment as a way to grow your wealth. However, trying to invest before having a solid savings foundation can be risky and counterproductive. In summary, while investment can be a powerful tool for growing your wealth in the long term, saving is essential for establishing a solid financial foundation and developing healthy financial habits. Without good saving habits, it is difficult to make the most of investment opportunities and maintain long-term financial stability. Investment is a marathon, not a sprint. A marathon is an endurance race that requires perseverance and patience to reach the finish line. Similarly, successful investment often involves maintaining a long-term strategy and resisting the temptation to make frequent changes in response to market fluctuations. Instead of seeking quick short-term gains, successful investment focuses on accumulating wealth gradually over time. This involves investing in solid assets and holding them for extended periods to allow the power of compound interest to work in your favor. Just like in a marathon, there will be moments of fatigue and challenges in investment. Financial markets can experience fluctuations and periods of volatility, but it is important to remain calm and maintain a long-term perspective, knowing that these fluctuations are a natural part of the investment process. Just as a marathon runner trains regularly to maintain their endurance and improve their performance, successful investors tend to maintain a consistent discipline in their investment approach over time. This involves making regular contributions to their investment accounts and maintaining an appropriate asset allocation based on their financial goals and risk tolerance. In summary, the analogy of investment as a marathon emphasizes the importance of persistence, patience, and long-term focus in the investment process. Just as in a long-distance race, success in investment requires preparation, consistency, and the ability to overcome challenges along the way. The value of time in the market. Time is essential to make the most of the power of compound interest. When money is invested, the returns generated by that investment can be reinvested to generate even more returns. Over time, this effect can significantly multiply the value of an initial investment. Financial markets are volatile and can experience short-term fluctuations due to a variety of factors, such as economic news, political events, or global events. Trying to predict and time these fluctuations is extremely difficult and can lead to inconsistent results or even losses. The time in the market approach involves investing and holding a position over time, while attempting to time the market involves trying to predict the optimal entry and exit points of the market to maximize profits or minimize losses. Studies show that, overall, investors who remain invested in the long term tend to achieve better results than those who try to time the market. Maintaining a long-term investment strategy and resisting the temptation to react to market fluctuations requires consistency and discipline. The value of time in the market lies in the ability to maintain that discipline and allow time and compound interest to work in your favor. In summary, the value of time in the market highlights the importance of maintaining a long-term investment strategy and resisting the temptation to try to time the market for quick profits. Instead of focusing on the perfect time to enter or exit the market, successful investors often focus on staying invested over time and letting the power of time and compound interest generate consistent and significant long-term results. If you're enjoying this video and want to support the channel, give it a like and subscribe, and if you're really committed to applying these 10 lessons from the book, comment "Master the Psychology of Money" in the comments. Diversification is key. Diversification helps reduce risk by preventing a single investment from having an excessive impact on the overall portfolio performance. By investing in a variety of assets, such as stocks, bonds, real estate, and other financial instruments, investors can mitigate the negative impact of volatility or underperformance of a particular asset. By diversifying the portfolio, investors can seek an optimal balance between risk and return. While some assets may have higher potential returns, they may also be more volatile. Diversification allows investors to take advantage of growth opportunities while limiting exposure to significant losses. Diversification also protects against idiosyncratic risk, i.e. risk associated with specific events affecting a particular company or sector. For example, if a company in which you have invested experiences a financial crisis or scandal, diversification reduces the impact of that loss on the overall performance of your portfolio. Different assets have different performance characteristics that may uniquely respond to various market conditions, such as changes in interest rates, inflation, or geopolitics. Diversification helps smooth out the impacts of these fluctuations by having exposure to a variety of asset classes that may behave differently in different environments. In summary, diversification is a fundamental strategy in investment management that helps reduce risk and optimize portfolio performance. By allocating funds among a variety of assets, investors can build more resilient and adaptive portfolios that help them achieve their long-term financial goals. Learning to live with uncertainty. Although financial analysts may use historical data, mathematical models, and other methods to try to predict the future behavior of the market, the reality is that the market is complex and influenced by a variety of factors that can be difficult to predict accurately. Financial markets are inherently volatile and can experience significant fluctuations in the short term due to a variety of factors, such as economic news, geopolitical events, or changes in government policies. Learning to live with uncertainty involves accepting that these fluctuations are normal and part of the long-term investment process. While it is impossible to predict or control all the variables that affect the market, investors can focus on what they can control, such as their risk tolerance, investment horizon, and diversification strategy. By focusing on these aspects, investors can make informed decisions that are aligned with their long-term financial goals. Learning to live with uncertainty also involves being flexible and willing to adapt as market conditions change and economic circumstances evolve. This may involve adjusting the investment strategy based on new information or changes in the economic environment. In summary, learning to live with uncertainty in the financial context involves recognizing the unpredictable nature of the market, accepting the inherent volatility and risk of investment, and focusing on what can be controlled and adjusted based on changing circumstances. By adopting this mindset, investors can develop greater resilience and make more informed and prudent decisions in managing their investments. The importance of a margin of safety. By purchasing assets with a margin of safety, investors are protecting themselves against the possibility that their estimates of intrinsic value are incorrect or that unforeseen events will affect the price of the asset in the future. The margin of safety helps reduce risk by providing an additional cushion in case the price of the asset temporarily falls due to market volatility or specific adverse events affecting the company. By purchasing assets below their estimated intrinsic value, investors increase their potential return as the price of the asset gradually adjusts to its true value over time. This can result in significant long-term gains when the market recognizes the true value of the asset. The margin of safety encourages a prudent and conservative approach to investment, prioritizing capital preservation over the pursuit of short-term returns. In summary, the margin of safety is a fundamental principle in investment that emphasizes the importance of purchasing assets below their estimated intrinsic value to provide additional protection against market volatility and the risk of loss. By adopting this approach, investors can increase their potential for long-term returns while minimizing the risk of significant losses. The power of compound interest. Unlike simple interest, where interest is calculated only on the initial capital, compound interest allows interest generated to be reinvested and generate additional interest. Over time, this process of repeated reinvestment can lead to exponential growth of the initial capital. The power of compound interest is most evident and significant in the long term. As time passes, the returns generated by reinvesting interest can represent an increasingly larger portion of the total investment value. Time is a critical factor in the power of compound interest. The longer an investment is allowed to grow, the greater the effect of compound interest. Therefore, starting to invest early and maintaining investments in the long term is essential to maximizing the benefits of compound interest. The power of compound interest applies not only to investment but also to other financial areas, such as mortgages, credit cards, and savings accounts. For example, when taking out a mortgage loan, compound interest can work against the borrower, increasing the total cost of the loan over time. In summary, the power of compound interest is a powerful tool for growing capital over time, leveraging the exponential growth generated by reinvestment of interest. By understanding and harnessing this principle, investors can maximize the long-term growth of their wealth and achieve their financial goals. The role of emotions in financial decisions. Emotions such as fear and greed can lead to irrational and detrimental financial decisions. It is important to learn to recognize and control our emotions when making financial decisions. Fear is a powerful emotion that can lead people to avoid risk and opt for more conservative financial options, even if they could have higher potential returns. This risk aversion can prevent people from taking advantage of investment opportunities that could be beneficial in the long term. Greed is another emotion that can influence financial decisions, leading people to pursue high returns without properly considering the risks involved. This can result in imprudent investments or impulsive decision-making that can lead to significant financial losses. In times of market volatility or economic crises, panic can cause impulsive reactions, such as mass selling of assets or withdrawal of funds from investment accounts. These emotion-based decisions can have negative long-term consequences and harm the ability to achieve financial goals. Overconfidence in one's investment abilities can lead people to underestimate risks or ignore warning signals. Confirmation bias, which involves seeking information that supports one's pre-existing beliefs, can exacerbate this problem by causing people to ignore objective data that may contradict their views. Emotions can be influenced by the environment and financial news. Positive news can generate irrational optimism, while negative news can increase fear and anxiety, leading to impulsive or irrational financial decisions. In summary, emotions play an important role in financial decisions and can influence how people assess risk, seek rewards, react to market volatility, and process financial information. Recognizing and controlling these emotions can help investors make more informed financial decisions and avoid costly mistakes in the long term. Learning from mistakes. Financial mistakes are inevitable, but learning from them is crucial to improving and growing as an investor. Reflecting on our mistakes helps us avoid making the same mistakes in the future. Instead of ignoring or minimizing financial losses, it is important to carefully analyze them to understand what went wrong and why. This may involve reviewing investment decisions, evaluating the factors that contributed to the losses, and learning from any errors in judgment or strategy. By reviewing past mistakes, it is possible to identify recurring patterns or problematic behaviors that may have contributed to those mistakes. This can help recognize areas for improvement and avoid making the same mistakes in the future. Building on the lessons learned from past mistakes, it is important to adjust and improve the financial strategy to avoid making the same mistakes in the future. This may involve changing asset allocation, diversifying the portfolio, setting loss limits, or adjusting risk tolerance. Learning from mistakes also involves developing a resilient attitude towards failure and financial adversity. Instead of being discouraged by mistakes, it is important to see them as learning opportunities and personal growth. Sharing experiences and lessons learned with other investors can be a valuable way to enrich the learning process and prevent others from making the same mistakes. This can be done through online discussion groups, financial forums, or even informal conversations with friends and colleagues. Learning from mistakes in the financial context involves reflecting on past experiences, identifying areas for improvement, adjusting the financial strategy, and cultivating a resilient attitude towards failure. By applying these lessons learned, investors can improve their financial decisions and increase their likelihood of long-term success. In conclusion, at the end of this journey through the psychology of money, I hope you have discovered the profound connection between your financial decisions and your life in general. From the value of saving to the importance of patience in investing, each lesson has reminded us that money is much more than numbers in a bank account. It is a reflection of our values, beliefs, and experiences. By learning to live with uncertainty and recognizing the role of emotions in our financial decisions, we have armed ourselves with the necessary tools to navigate the complex world of finance with confidence and clarity. And remember, every mistake is an opportunity to learn and grow, guiding us towards a brighter and more solid financial future. So keep exploring, keep learning, and keep growing. If you enjoyed this video and want to support the channel, give it a like and subscribe, and if you're truly committed to applying these 10 lessons, comment "Master the Psychology of Money" down below. Thanks for watching.